Good afternoon, ladies and gentlemen. So I will spend the next 15 or 20 minutes talking about the deal-making environment more broadly, and then narrowing in at the end on the LBM industry in general. I will try to keep it interesting, but given some of the programs or presentations earlier, I can't promise that I'll live up to those expectations, but we'll do our best. And I'll leave open at the end again some time for some questions. So I've been doing this for about the last 15 years, this being investment banking. More specifically to this sector, I've been doing it for about the last 7 years. I go across the kind of investment banking platform, capital markets, as well as M&A, but I spend a lot of my time in the M&A environment, so I'll share with you a little bit about what I'm seeing out there, and hopefully that is relevant to what you're seeing or planning to do, and then a little bit on what we can expect given some of these statistics. Now, some of these stats I will move through in this presentation perhaps aren't directly related to you, but for these sorts of analysis or presentations, we go to where the numbers and figures are so that we can use those to try to derive conclusions, again, about where we think things are going. So first of all, start with a snapshot of the macro environment to right-size things as we get into some of the more details specific to the M&A environment in LBM distribution. I would say this, we have 4 statistics on this page here and an overall snapshot of the macro environment. And I'd characterize it as slowly getting better. We're optimistic, as you can see in the upper right-hand corner, that 14 is going to be better than 13. But if you go back a year from where we are today, we would have said the same thing about 13 to 12. So, the stats, the indicators are out there that things are getting better, perhaps not as quickly as some of us would have hoped, but, trending in the right direction. Other stats here on the page are unemployment, continues to trend downwards. We had the unemployment report last week, not as perhaps as optimistic or as favorable as we had hoped, but generally, employment, maybe not the hours, not the compensation that we're hoping for, but we're definitely gradually chipping away at that unemployment rate. You look at the ISM manufacturing index, anything over 50 is a proxy for the manufacturing environment expanding. So you can see that we more recently have trended very positively there. And then probably most pronounced, what we're seeing is the S&P 500, recently reaching all-time highs in the, as an indicator for future business activity or in general where the economy is going. So in general, it's the macro environment is very favorable. Now, as we transition to more the M&A and thinking about that, you should broadly think of M&A, and I know many of you in this room have, completed M&As, perhaps sold businesses, acquired businesses, and stuff like that. So you'll know that I say M&A is a very complex task requiring the planning and measurement and the control of an infinite number of moving pieces. So I'm going to spend some time talking about some of those pieces here today as again, trying to figure out where things are going from where we are today. So next slide. This just looks at the debt markets. The debt markets being where we are today. Now this measures the high yield environment or the leveraged loan environment. High yield being debt bonds, or otherwise known as junk bonds. In the upper right-hand corner, we have the leveraged loan, and then we have the cost of bonds down below. So again, not a lot of you are going to be using this sort of security in your own capital structures, but it's a good proxy and it's a good M&A, or it's a currency often used by acquirers of businesses in the M&A process. And what you see here on the upper left is high yield issuance. So again, that's a junk bonds, and you can see 2013 record activity in terms of where we were catching up to 2012. This slide's a little bit old, but we roughly finished very close to where we were in 2012, 2012 being an all-time favorable environment. In the leveraged loan market, you can see that this is 2013 year to date. Finished a year out, we actually would have surpassed where we were in 2007, the previous record. And then down below on the bottom of the page, you see the interest rate or the yield environment. A lot of moving pieces there, but one thing I'll point out to you is, in the far right-hand corner, you have the 10-year Treasury, so where the U.S. government is issuing 10-year paper. You can see that they're issuing paper inside of 3%, but maybe perhaps more relevant is the BB index, which is a credit, a junk credit, or a high-yield credit. And what's interesting is if you look at where those BB issuers are issuing paper today, at roughly about 4.7%. That is on average where the U.S. government has been issuing paper for the past 20 years. So pretty interesting in terms of the environment that we're in, unbelievably favorable debt environment for borrowing capital, an abundance of investors on the other side willing to loan businesses money for a variety of operational activities, but as well as M&A activities. In addition, just the abundance of capital out there. Capital can be had at an unbelievably, and some of the speakers here today will touch upon this in more detail, but had at rates and terms that are as good as it's been in a very, and perhaps as good as it's ever been. So one of the main currencies for M&A is very, very strong. So something to take into consideration as we move a little bit deeper into this presentation. Now looking at the M&A market more broadly, what you have here on the left side of the page is overall monthly M&A activity. And then what we have here are three key indicators that some of the statisticians at my company have found to be some of the leading or have the highest correlations with overall M&A activity. And those three things being the S&P 500, consumer confidence, and then volatility or the lack thereof. And what you have here on the page over on the right, you can see that M&A is up roughly about 42% from its trough in October of 2009. But these three leading indicators, the S&P 500 up more than 170% from its low in March of 2009, the consumer confidence up 180% roughly from its low in February of 2009, and then the volatility index, some of you might not be familiar with that, it measures volatility or expected volatility over the next 30 days in the S&P 500, often known as or often characterized as the fear index. And you can see that that 80% contraction in that volatility, very positive. So why are these relevant for the M&A market? S&P 500 and also the consumer confidence, the outlook in terms of where things are going, the lack of volatility, M&A again being a very complex task in terms of measuring all these variables, controlling all these variables and so forth. The lack of volatility helps you plan the direction of the S&P 500, consumer confidence, optimism about where things are going. In many ways, M&A is a very calculated bet in terms of where we think the deal environment, the industry, the competitive dynamics are going. So these indicators all point to a very robust growth in M&A in terms of where they've gone from their trough to where they are today. But when you look at those statistics, up 180, up 180, down 80%, and then you look at that M&A environment, about 40% up, there's been a little bit of a breakdown in the overall M&A market in terms of where it should be relative to where it is today. And we're going to talk about that a little bit more in some of these later slides. In terms of M&A, all M&A transactions require a seller as well as a buyer. So taking a step back and looking at the buyer environment, two of the most prevalent buyer groups are going to be corporate buyers, so companies being public companies, private companies, and then the private equity group or private equity industry out there. So looking at the top half of the page, it looks at some of the currencies that corporates use. Cash on the balance sheet up significantly. Borrowing costs, we touched on this before, at record low rates as well as record low favorable in terms of covenants and what you have. And then the S&P 500 in terms of a proxy for where their own businesses are going and or used as a currency in M&A. So very, very favorable in terms of looking at the corporate buyers. And then the private equity period, looking at the holding period, and these being private equity groups at the end of the day buy and sell companies, given where we have gone with the economy and the contraction and so forth. A lot of these companies are getting long in their portfolio, so very ripe for an eventual sale. The middle statistic looks at the dry powder. So this is the equity capital that the U.S. private equity industry has raised, so roughly about $400 billion of capital. When you lever that up, they roughly have about $1.2 billion or $1.2 trillion, I should say, of purchasing capacity. And then you look at the equity funding. Certainly in the dog days back in 2009, very difficult or much more difficult lending environment. Private equity groups required to fund the capital cost of these acquisitions with a lot more equity. Certainly as the outlook has improved, the debt markets improved, they're not required to put as much equity in these leveraged buyout transactions. So buyers, very favorable, sitting on a lot of capital, very motivated to put capital to work to try to do these, facilitate M&A transactions. So broad macro indicators, M&A should be up significantly. The buyers, the people that help facilitate at least one half of the M&A transaction, abundance of capital and interest in doing deals. So where are we today? When you look at here, this tracks the global M&A environment and represents 3 cycles going back to 1989. 1989 being one peak. It's a little bit more challenging to see just given the peaks in 2007 and 2009, but you can see the roughly about 600, this is not millions, but this is billions, or this is actually trillions, 600 billion of activity and contracting, rising to a peak of about 3.5 trillion in 2000, and then another peak of 4.6 trillion. And you can see on average these M&A cycles from peak to trough represent about 2 years, and then the length of the M&A boom varies. You know, it was back in 9 years in terms of the 1990s, 5 years in the first part of the 21st century, and then now we're in kind of a new environment. But what you've seen is, you know, pretty consistent peak, trough, and a rebound in M&A activity. But if you go all the way to the far right of the page, you've seen a little bit of a stagnation here in M&A activity. And what we're going to look at in the next page is what's happened. So these 3 cycles that I was talking to, 89, 2000, and 2007, you can see roughly the first year of the downturn, 90, 2000, and 2008, on average down 30 to 50%. The second year down on average 20 to 30%. And then you see stabilization in the market in the third year of that peak. So peak to trough, roughly about 2 years. That third year, you see stabilization. The 2 prior cycles, after that third year of stabilization, we experienced very robust growth, on average, you know, 30, 20, 60%. In the 90s, 40, 40, 35%. In the 2000s, saw a little bit of a rebound in 2011, and then a stagnation, almost a contraction, a slight contraction in the M&A market in 2012 and 2013. So again, all the macro indicators are there. We should be seeing a more robust activity in the M&A. The buyers, the corporates, the financial buyers, ripe for activity. The lending environment, the currency that a lot of these buyers are going to use is there, an abundance of capital, but we're not seeing an uptick in overall M&A activity that one would expect given where we are in the cycle. So why? What's happening there? And there's a number of qualitative reasons in terms of, you know, my opinion as well as other experts in terms of what we're seeing. Certainly the Fed scaling back liquidity, the mixed signals coming out of Washington from a liquidity perspective, introducing a little bit more volatility into the markets, making things a little bit more challenging, making it challenging for people to plan in the future. Certainly, you know, not depending on where you sit on the aisle in terms of Washington, Democrat or Republican, certainly the political impasse and Washington's lack of ability to actually get things done, certainly making it, again, very difficult for people to plan, to conduct M&A, and going back to that other thesis that M&A being a very complex proposition or exercise when managing a lot of different variables, the political impasse in Washington, the lack of things getting done, and the challenges with planning is certainly not giving people confidence in terms of where we're going and so forth, and making it difficult again to plan to what the future is going to look like. Certainly, we're moving into an environment of heightened regulatory, a lot of new rules, companies needing to adjust to those rules. Again, a planning exercise when the rules and the goalposts are moving on you. It's a little bit more challenging to conduct M&A and get people lined up and give the buyers the confidence to do deals. Certainly, you know, when you look at Europe and some of the emerging markets in terms of the volatility, both from a political and economic landscape, certainly not making things easier, recognizing that the LBM industry is very much of a domestic industry, but again, looking at the broader M&A market, not helping things. And then one of the biggest things that's probably putting the most challenges, and again, this is macro, but perhaps even more specific in the LBM industry, is the difference between seller and buyer price expectations. We've gone through, you know, the all-time worst recession in the building materials industry, and a lot of people are still remembering what they did back in the early part of the 21st century. We're trending positively. Sellers have expectations of what counterparts, their peers, got back in the early part. Buyers looking at the more realistic environment in terms of where we are, where profitability is going. You're having a challenge in just terms of seller expectations being up here, buyer expectations, or willingness to transact being down here. And until we get a little bit deeper in the recovery, that difference is making M&A in general and the agreement on price a more challenging aspect. And then again, the last thing would be the IPO environment. We are in one of the all-time most robust. I mean, going back to the the late 1990s with the tech boom. If you look what's going on, the all-time rotation into the equity markets, the IPO market is stealing, and we've seen this a lot in the building products industry more recently. But stealing, quote unquote, stealing a product from the M&A environment and pushing companies that perhaps were too small or people perceived as being too small or not ideal IPO candidates into the IPO environment, which is again pulling product away from the M&A into the public equity markets. So now I'm going to switch gears a little bit more towards the LBM industry. So taking what we learned from a macro perspective and drilling down to more of a micro level that's most relevant to us here in the room today. This is a snapshot of new housing construction. Most of you are very familiar with this. The stats, the first top half of the page are new housing starts. You can see that they have been trending favorably over the last couple of years, but when you look at that long-term average of roughly 1.5 million starts, even with the improvement in activity, we have a long way to go in terms of getting even back to normalized levels. When you look at the top half of the page is the evolution of the population. So that trend line since 1959 is, again, just taking all those numbers and the average, when in fact the country's population is almost doubled. So you could even make the argument that 1.5 is not the new normal, or the new normal should be somewhere higher up from that. But the conclusion here is, housing's getting better, new resi's getting better, but we have a long ways to go in terms of getting back to more, a more normalized environment. Lower left-hand corner looks at new housing starts. You can see that this captures gross orders less cancellation rates for the public builders. And what you have here is you've seen just a trend line in terms of, very favorable in terms of what they're, 30% plus year-over-year growth in terms of what they're reporting. And then the lower right-hand corner is the market share for the top public builders, and they continue to take share. I can make a product. You can make an argument that's dependent upon capital and their access to capital and so forth. But the overall conclusion here is, new housing is getting better. The big builders seem to be benefiting more than the mid-tier builders, but the overall environment is, certainly getting better. Looking at R&R, this is a proxy of just household wealth, and this is, as trying to derive what the trends in the R&R market are going to be. You can see in the far left-hand corner, housing net worth is growing, and you can see at the upper right-hand corner looks at the recovery. Now, part of this, and you can see that the current recovery that we're in is, as strong, or one of the more stronger recoveries and better than certainly the average. And, that's a product a little bit of, how low things got. But in the lower right-hand corner, you can see home equity value. And we're starting to see, we have a long way to go to get back to where people were. But you finally see the confidence of homeowners and their willingness to transact and invest back in their homes is growing as their consumer confidence improves, but more perhaps importantly, is as they start to see a return and growing in the home equity and their ability to pull out financing and invest back in their home, and or their confidence in investing back in their homes in terms of this not being a sinking investment, getting above where their mortgage levels are, and certainly a good investment for the consumers. Changing gears to building materials. So this looks at a couple of different things. It looks at share prices and valuations. Share prices being in the upper left-hand corner, valuations being in the lower left-hand corner, and then up in the upper right-hand corner are profits, and then the deleveraging in the lower right-hand corner. And again, this is a somewhat outdated slide, but the conclusion here I'll draw from you is certainly valuations as people anticipate a recovery in the building materials environment. Valuations are growing significantly. You see that in the upper left-hand corner with share prices, as well as the valuation multiples in the lower left-hand growing. Those being just firm value representative of EBITDA, a common proxy used in the building materials environment to determine or look at valuation. And you can see the profits. Profits are growing significantly. Leverage is still something companies are dealing with, but we're starting to see an improvement, value, profits, and leverage that are making people more interested in transacting in the LBM environment. Now, specific to LBM distribution, what we have here is a couple of different things and setting up to terms of where we think things can go given the overall improving macro environment, the improving housing statistics, both R&R as well as new resi, improving LBM or building profits and valuations. Now taking a step back into LBM distribution and what it means to many of the people here in the room. Upper left-hand corner is a proxy for about $400 billion, the size of the home improvement spending. Roughly, LBM distribution is about 12% of that, or about $50 billion. In the bottom part of the page, you get the top 10 LBM distributors. ProBuild at $3.6 billion on the far left, Meeks on the far right. And then moving across the page up into the upper right-hand corner, you can see that in that $50 billion industry, the top 10 represent about 21% of the industry. The other people with more than 100 million of sales, roughly only about 8%. Small group in that 25 to 100, but the vast bulk, or 2/3 of the industry, is roughly characterized by companies with less than 25 million in sales. So very fragmented industry relative to a number of other sectors out there. And we look at an example of that. We're looking at the distribution industry. Top half of the page is a retail, Home Depot, Lowe's, Menards, and then the bottom half is that LBM distribution. And you can see back in 2009, roughly the top three controlled about 71%, top three being Home Depot, Lowe's, and Menards. That has grown in 2012 to those top three representing about 96% of the home center business. But down below, you can see the LBM distributors, the top three about 30% 2009, growing, again, like the players at the top half of the page, to 37%, but a very different consolidation perspective relative to what we've seen on the home center or retail side. So again, a very, very fragmented industry, one very ripe for consolidation. And the next page looks at building products, M&A activity. And interestingly, you can see that back in 03, 04, 05, we saw a surge in values as a result of a lot of people putting capital to work, that being right before the downturn, so valuations were inflated, profitability were inflated. But we can see more recently on the far right hand of the page is 11, 12, and 13, a significant uptick in building products activity and multiples moving up as people coming off that trough profitability. So the conclusion here is, despite the overall M&A market being challenging, we're actually seeing a decent amount of M&A activity in the broader building materials industry, as many buyers, those buyers ripe with cash, buyers ripe, private equity groups ripe with capital, look to get long the cycle and transact in the LBM industry. And summary and conclusions here are, what are we seeing broadly? Macro economy is improving, albeit slowly. You certainly we find ourselves in a very favorable lending environment. Capital, especially for larger companies, is very easy to come by. All the ingredients are there for a surge in M&A activity. The broader M&A market continues to struggle as a whole, but certainly LBM activity, we're seeing an improvement. The housing is growing again, has a long way to go, but we're in the early innings of what should be, a 3, 5, 7-year recovery. Investors, buyers of assets are looking to put capital to work to try to get long that recovery. And certainly LBM distribution in general, relative to many other industries, very fragmented, ripe for consolidation, given some of the dynamics we've seen and the scale advantages in consolidation in other distribution sectors. So that's pretty much all I had here to say about the LBM distribution, or the LBM distribution M&A environment, overall M&A environment, capital environments. Happy to take any questions people might have about these various categories.
Just me, or do you feel like you got a 2-year MBA degree in 25 minutes?
I told you it's going to be a little bit drier than some of the other presentations.
So you talked about the lending environment's much more favorable in general. Can you talk to how banks and debt issuers are thinking about lending to LBM specifically, or anything in the housing sector?
Yeah, I can speak, more broad. I speak for my bank, and then more broadly in terms of what we're seeing out there in the sector. I certainly think it's slowly, again, perhaps, I think we'd all hope that banks would be opening the spigots a little bit quicker. But certainly when we go in terms of looking at our overall portfolio, and again, I cover a couple of different sectors. It's LBM distribution, it's the home builders, which perhaps have an even more cyclicality than the LBM distribution, and some of the other building materials companies out there. Certainly, looking to put capital to work in favorable. Banks are being more prudent, a little bit more structured in terms of how they're putting that capital to work, but certainly the banks, and I see this a lot of my competitors out there, very willing to put capital to work, and people see the recovery. They see now being a smart time to be putting capital to work and lending to these companies as we come off the bottom and we move deeper into this recovery and stuff like that. So you're seeing a much more favorable environment, and certainly speaking, for my bank's behalf as well as some of my competitors, it's certainly a lot easier to get capital out there. Is it back to the levels you saw in 2006 and 2007? No. Are there more restrictions with some of that bank capital? Yes. And that's a lot of the reasons why people have moved into the leveraged loan market or the high yield environment, just a lot less restrictions and capital easier to be had.
Hi, Ben. Thank you.
Hey, how are you?
That was great. I didn't think I could feel less smart than I did 20 minutes ago. But my question is, in specific to the lumber business, you talk about a lot of capital being available and becoming available, and there's a lot of money that's on the sidelines that's ready to be lent. As far as a group here, is there something specific in the metrics, which is something that we look a lot at, that a bank wants to see from a lumber distribution perspective that says, this makes sense, this is a good deal for us, this is something that we like as far as an equation?
Sure. I'd say there's probably two things that you're seeing. One, cash is king. They want to see the prudent measurement and control of cash flow in terms of what this business is looking. Certainly a bank is going to be a lot less willing to lend into an environment where a company is losing cash or has negative cash flow environment. But at the same time, banks understand, certainly as we're coming off the cyclical trough in an LBM industry, there's a lot of inventory that needs to go back into these yards and these businesses, and that requires capital. So positive cash flow is a good thing for lending, but also it's the assets in terms of what sort of assets you're acquiring, your ability to turn those assets, your ability to measure those assets, control those assets, monitor those assets, and so forth. You know, certainly when you look at revolvers as being a proxy, it's a lot easier to get an ABL revolver these days in terms of asset-backed lending relative to a cash flow revolver, and just banks' willingness to want to lend to hard assets and be able to hard assets securing the cash that they're putting into these businesses. So cash flow, very good thing, and demonstrating business plans where you maintain positive cash flow, your ability to delever and pay back these loans, and then good assets backing up the loans that these banks are putting into these companies. Yeah, and LBM specifically, I'd go back to the point, the disconnect between buyer and seller expectations. You know, the recovery in the industry is getting better, but you know, go back to those housing statistics, right? We're getting better, but we're still inside roughly about 1 million starts, which would put you kind of at the old cyclical troughs. So people are realistic in terms of what they're seeing and where we are, but we have a long way to go. And people, sellers, look at, you know, hey, this is my friend or my peer, my competitor sold back in 2007 for this price. I want this price. Well, you know, their profitability back in 2007 was 3x what your profitability is today, and where we're getting better, we're far from where things were back at 2.1 million starts. So the biggest thing is, you know, that lining up buyer and seller expectations. And I think part of that is just the slope of the recovery. As we get deeper into the recovery, and you'll start to see that slope playing out a little bit, buyer and seller expectations should start to line up a little bit more reasonably. And I also think sellers, as they look at selling their businesses, as they get profitability up, they get the value up a little bit. It's maybe not what their peer got back in 2007, but you know what? It's been 7, 8 years since my peer. I'm getting a little long in the business. We've had this a number of years. I feel like I'm getting fair value. I don't feel like my pocket's being picked. That's a value that's fair, and the buyer, you know, lines up with where the buyer thinks the business is going or where they see value. But really, right now, that's in most of the conversations I have, the disconnect between buyer and seller expectations on value seems to be the factor that throws M&A off the most in our industry. Yeah. Well, I mean, in terms of overall housing activity or overall M&A activity? Yeah, I mean, most of the statistics my bank as well as other third parties look at, getting back to over the next couple of years of roughly about 1.4, 1.5 million starts. That would put you on average with what we've done in the last 50 years. Again, going back, despite the population almost doubling the market. So 2-3 years out from now, you get to 1.4, 1.5 million starts if the third party forecasters are correct. That just puts you in a normalized environment. You could even say a subnormal from where we are and how big the country is. So you find yourself there. We should have, at least a couple more years left in this cycle. Again, though, it's difficult to predict and so forth. And you're right, a lot of people got stung doing big deals back in 05, 06, 07, buying companies right before we went over the ledge, and that certainly had a negative impact to some of these buyers. But those buyers are changing. They're getting capital again. New regimes, and they're certainly getting back into the deal environment.
Thank you, Ben.
No problem. Thank you very much.